Uh, Good afternoon, students. So today we will be moving on to a new lesson in grade 11 syllabus for the business and accounting studies. So far we completed three lessons: trade and supporting services, management, and marketing. And from now on, we will be moving on to more of accounting side of the syllabus. So earlier we studied mostly about business studies, and now we are moving on to the accounting side of the syllabus. Okay. So in this lesson, the financial statements of a business. So this lesson is basically about financial statements, and it is the start of the accounting lessons in the grade 11. So it is important that we will be focusing about this lesson as well as its content from the beginning itself. Okay. So we will be learning about introduction to financial statements, the profit and loss statement, and statement of financial position in this lesson. So we will be learning about profit and loss statement as well as statement of financial position. Okay. So as I said, so far we completed trade and supporting services, management and marketing lessons. Okay. So let's begin today's lesson. And so initially we are going to learn about sort of like we are going to look at an introduction. Okay. Introduction to financial statements. So initially we are going to look at what are financial statements and how we come to the point of financial statements, and what are we expecting or what are we expected to obtain from financial statements. So those are the basic things that we are going to look at initially. Okay. So in accounting process, the business transactions are first recorded in prime books and then posted to ledger accounts, and then ledger accounts are balanced and taken into trial balance. So those things we learned in grade 10 syllabus. So what is happening? So initially, first we record them in prime entry books. Okay. Prime entry books. So we learn about this in grade 10 syllabus. Okay. Then from this, we will be extracting them into ledger accounts. Okay. Then we are recording them into ledger account debit side and credit side. After that, what we do is we are preparing the trial balance. Okay. We are preparing the trial balance. So those things we learned in grade 10, right? In the grade 10 syllabus, we already learn about this. Okay. So in if you look at the objective of a business, okay, if you look at the objective of a business, okay, objective of a business, what is the objective of a business? It is always to earn profits. Okay. Earn profits. Main objective of a business is to earn profits. So the objective of any business is to earn profits from their business activities. Therefore, it is worthwhile to see whether there is an adequate operational profit to continue the business. Now, you can continue a business, okay, you can continue a business only if there is profit. Okay. Now, let's say your business is making losses. Okay. If your business is making losses, what will happen? You will close down the business because you don't want to continue it. Let's say you are doing a business and you are consistently making losses. Okay. Then what happens? You don't want to do that business anymore. Okay. So you will be closing off that business. Okay. So as our objective is to know whether a business is earning profits, okay, whether a business is earning profits, it is worthwhile to see whether there is an adequate operational profit to continue the business, okay, to continue the business. So also it is important to see the financial position of the business reflect to assets, equity, and liabilities. Okay. Now here we are looking at two things. Okay. Here we are looking at two things. One thing is now operational performance, okay, or You can say profit. The next thing is, okay, next thing is financial position. Financial position. So those are the two things that we want to look at in a business. Okay. So such information assist in making decisions of the future business in an organization. Okay. So accordingly, to obtain an understanding on the financial performance of the business during a specific period, and to obtain an understanding on the financial position of the business of a uh, particular business, we need financial statements. So we need financial statements for what? We need financial statements to know the financial position of the business as well as operational performance of the business. Okay, so the financial statements are prepared to identify the operational results and the financial position of the business. Okay, so financial statements of a business are prepared for a specific period of time, and it is known as accounting period. Generally, it is considered 12 months of 12 months. Okay, the financial statements are regarded as output of the accounting process. Okay, let me sum up what we learned so far. Okay, now when we were in grade 10, okay, we were looking at the initial stage or the basics of accounting. So what we did was we firstly recorded them in prime entry books. Okay, we firstly recorded them in prime entry books. Then what happened? Then we recorded them in ledger accounts. Okay, then we recorded them in ledger accounts. Then finally, what we did was we took it to trial balance. Okay, this is what we learned in grade 11. Now we also learn, now for an organization to, like, when we are doing a business, we need to like meet objectives. We need to have objectives. One of the main objective is earn profits. Okay, earn profits. Now main objective is earning profits. Now, let's say that you are doing a business and you want to earn profits. Now, if you want to earn profits and if you are doing a business and if you are a manager in it, as you do the business, you need to know whether the business is earning profits. Okay, whether the business is earning profits. Because if the business is not earning any profit, then you will have to close down the business. Okay, business එක profit එකක් හොයන්න නැත්නම් what will happen? You will have to close down the business. And as well, you will also need to know the financial position of the business. Okay, you will also need to know about the financial position of the business. So you will need two things. One is operational performance, and the second one is financial position. So you need to know about these two things. And as a manager, as a business owner, how do you know about these two? Okay, how do you get to know about these two? That is with financial statements. Okay, that is with financial statements. Okay, so financial statements are prepared to identify the operational results. Okay, operational performance or the profit and the financial position of a business. Okay, now when you are doing this, there is another important thing. Okay, so you will be looking at these two, no, operational performance and financial position. So what you do is you are looking it for a particular time period. Okay, you are looking it for a particular time period. Usually it is for 12 months or 1 year. Okay, you are looking at this operational performance of the business and financial position for a 1 year. For example, let's say operational performance for a period of 1 year and financial position at the end of the that 1 year. Okay, so this thing, okay, this thing we call it accounting period. Okay, accounting period. Okay, financial statements of a business are prepared for a specific period of time, and it is known as accounting period. Okay, and it is generally considered 12 months. Okay, from month 0 to month 12. Okay, the financial statements are regarded as output of the accounting process. Okay, so we learned about this basically in grade 10 syllabus. We learned about the accounting process. So what happened is, now we have the inputs. Now you can see it. Firstly, we have the inputs. Okay, so those are, one second. So now, so in grade 10 also we studied about the accounting process. Okay, so we started like, we sort of like initially learn a little bit of accounting process. Now in accounting, what you have is, firstly, or you have the inputs. Okay, like anything, you have inputs. Okay, then you have accounting process, and then you have the output. Okay, so you have input, accounting process, and output. Now in accounting, what are these inputs? Okay, those are the transactions. Okay, those are the transactions. So we have cash transactions, we have credit transactions. Okay, we have two types of transactions, cash and credit. Okay, so accounting process is the process where recording the transactions in prime entry book and posting them into ledgers and preparing trial balance and adjustments. Okay, so here it includes first entering them in prime entry books. Okay, and then in ledger accounts. Okay, and finally in the trial balance. Okay, and after that, what you have is, you will have financial statements. Okay, as the output. So you have inputs and you have the accounting process and outputs. So financial statements are regarded as the output of the accounting process. Okay, so those are the basic things that you need to know about introduction to accounting. So basically, we need to look at the financial position and the financial performance of the business. For that, we need financial statements. Why do we need to look at the financial performance and the financial position of a business? Because the main objective of business is to earn a profit, and you can assess the profit looking at the operational performance or the operational results and financial position of the business. Okay, so financial statements are prepared for various business organizations, and in this chapter we will be looking, or we will be focusing on preparing two financial statements for a sole proprietor or sole trader types of business organization. අපි මේකදී බලන්නේ sole proprietor එහෙම නැත්නම් තනි පුද්ගල ව්‍යාපාරවලදී කරන accounts ගැන තමයි අපි grade 11 syllabus එකේදී කතා කරන්නේ. Okay, so sole proprietor business prepare two main financial statements to ascertain the operational result and the financial position of a given accounting period as follows. They are profit and loss statement and the statement of financial position. Okay, so those are the two statements, profit and loss statement and the statement of financial position. Okay, so those are the basic things that we discussed. So we can start writing the note. I will read it out. Okay, so you can start writing it. Financial statements of a business. So this will be the main subheading, and then you can put the subheading as financial statements of a business is the main heading, and then subheading will be financial statements. Okay, in accounting process, business transactions are first recorded in the prime books, prime entry books, and then posted into ledger accounts. After that, ledger accounts are balanced and then balances are taken into trial balance. This process has already been explained in detail in the grade 10 study text. The main goal of any business is to earn profits from its activities. Therefore, it is important to analyze whether the business is making enough operational profits to continue running. Additionally, understanding the financial position of a business reflect through its assets, equity, and liability is also crucial. This information helps in making making informed decisions about the future of the business. Okay, then you can write down the next slide. I will read all these slides so you can write them. Uh, to assess the financial performance of a business over a specific period and its financial position at a particular date, financial statements need to be prepared. These statements help determining both operational result and overall financial status of the business. Financial statements are usually prepared for a specific period known as accounting period. This period is generally considered to be 12 months. The financial statements are regarded as final output of the accounting period. Then you can draw this diagram. Okay, input, accounting, process, and output, and then the financial statements are prepared for various business organizations. A sole proprietor business prepare two financial statements to ascertain the operational result and financial position of a given accounting period as follows. And they are profit or loss statement and statement of financial position. Okay, so you can take a couple of minutes and start writing the note. Okay, so we studied sort of like introduction to financial statements, and we learned that we are going to learn about two financial statements, profit or loss statement and statement of financial position in this lesson. Okay, so firstly we are going to learn about profit or loss statement and few things inside that, such as what is the gross profit, what is the net profit, likewise. Okay, so profit or loss statement is prepared by a business organization to calculate the profit or loss earned during a particular accounting period. This statement was also known as the statement of income in the past, but now it is known as profit or loss statement. Calculation of profit or loss of a business is performed in two steps. First is calculation of gross profit, the second one being calculation of net profit. Okay, now and profit. Okay, now to know this, whether a business has earned sufficient profits, we are going to need some information or some statements or some reports. So what is that report? That report is profit or loss statement. Profit or loss that statement is profit or loss statement. Okay, that is the statement. Now the important thing is this profit or loss statement. Okay, it is prepared, okay, for a particular period of time. Okay, now for example, now it is been like told as profit or loss statement is prepared by a business organization to calculate the profit or loss. Okay, to calculate the profit or loss earned during a particular accounting period. Okay, now this is during this period. Okay, during this month 0 to month 12. Okay, during that period. Okay, now sometime back this was also has been called statement of income. Okay, now we in this syllabus we call it profit or loss statement. Okay, now profit. Okay, profit, we calculate it in some form of like two steps. Okay, first we calculate the gross profit. Okay, and then we calculate the net profit. Okay, let's see how we calculate the gross profit and net profit. Gross profit is basically it's about revenue deducted by its cost of sales. But when it comes to net profit, includes much more items in it. Okay, gross profit is sort of like initial screening. Mage gross profit එක කීයද? Then after knowing that gross profit, you are going into net profit, which includes more and more other subcomponents. Okay, so the gross profit is calculated by deducting the cost of sales from the sales revenue. Okay, now we are going to learn about the gross profit. Okay, okay. Now, how we arrive gross profit is equal to sales revenue, okay, minus cost of sales. This is how we calculate the gross profit. Sales revenue minus the cost of sales. The gross profit is calculated by deducting the cost of sales from the sales revenue. So we have three terms here: gross profit, sales revenue, and cost of sales. So now we know the gross profit. Gross profit is derived by deducting cost of sales from the sales revenue. Okay, one, that is done. Okay, now we are going to learn about what is sales revenue. Okay, the total cash sales and the credit sales done during a particular time period is known as the sales revenue. Okay, එතකොට sales revenue එක කියන්නේ මොකක්ද? Sales revenue includes two items. Sales revenue includes two items. Okay, now sales revenue includes two items. Those are cash sales, okay, and credit sales. Now, let's say we did a sale. Okay, I sold something to a customer, and that customer settled that transaction immediately. Then it is a cash sale. Now, let's say I have made a sale, but that customer has not made the payment at that moment, but he might be paying it in, let's say, another 3 months' time. That is credit sale. Okay, cash sale and credit sale. Now, sales revenue includes both of these, cash sales and credit sales, both the components. Okay, the total cash sales and the credit sales done during a particular accounting period is known as the sales revenue. For example, let's say we have cash sales. Let's say we have cash sales 58,000. Okay, and then we have sales, let's say 76,000. Okay, now if someone asks us what is the total sales revenue or what is the sales revenue of this business, okay, the answer will be the total of both. Okay, total of both. Okay, that will be 1,34,000. So that is the sales revenue. Okay, so let's take a couple of minutes and write the points up to this point. Okay, so you can write it looking at this statement. Okay, so I will read it out so you can write it. Okay, profit or loss statement. Profit or loss statement is prepared by a business organization to calculate the profit or loss earned during a particular accounting period. This statement was also known as the statement of income in the past, but now it is known as the profit or loss statement. Calculation of profit or loss statement of a business is performed in two steps: calculation of gross profit and calculation of net profit. Okay, the gross profit is calculated by deducting the cost of sales from the sales revenue. So sales revenue include, and then we can write the sales revenue. So you can put the subheading as sales revenue, and then the total cash sales and the credit sales done during a particular accounting period is known as the sales revenue. Okay, so cash sales and credit sales, the total will be the sales revenue. So you can take a couple of minutes and start writing. Okay, so we learned about the essence of gross profit. Okay, gross profit is sales revenue minus cost of sales. And then we learned about sales revenue. Sales revenue is the total of cash sale and the credit sale. Okay, so then now we are going to learn about the cost of sales. Okay, the third item is so third item we are going to learn is cost of sales. Okay, now cost of sales is it have several components. Okay, let's dive into it and let's see what is cost of sales. Okay. Once the entire stock is sold out, the cost of the inventory that was presented for trade is considered as the cost of sales. Once the entire stock is sold out, the cost of the inventories that was presented for the trade is considered as the cost of sales. But a business organization can have some inventories yet to be sold at the end of the accounting period. Okay. In such situation, the cost of sales is calculated by deducting the value of the closing stock from the cost of the goods that were presented for sales. Okay. Example, the same closing stock as at 31st December 2015 become opening stock at the 1st Jan 2016 in the next accounting period. There is no opening stock existed for a business in the first year of operation. In the particular accounting period, a business has to purchase goods to sell as the opening stock of good is not adequate for the sale done during the year. The purchases made in cash and credit, total of the purchases made during the purchases made in terms of cash credit totals for the purchases made during the accounting period. Okay. Okay. Now I will start from the scratch. Okay. Now let's say we started a business. Okay. We are starting a business. Okay. Now this is the month 0. Okay. Now we are preparing the accounts for how long? For month 12 months. Okay. Now let's say we started the business. Okay. We start the business. Now what happens? We are buying some goods. Okay. Let's say we are buying a stock of goods. Okay. We are buying goods. And out of this, what we do is no, that drawing is not nice. Okay. Okay. That drawing is not nice. Okay. Let's do it like this. Now let's say, okay. Now let's say we bought some goods. Okay. We bought some goods. Okay. We bought some goods. Okay. We bought some goods. Now what happens is during the year, we are consuming now, let's say what? Mm, let's say we are doing what would be best? For example, okay, some hypothetical example, okay. Let's say we are doing a noodles business. Okay. We are doing a noodles business and we are importing new noodles. Okay. So in the year 0 or in the month 0, as we start the business, we imported, let's say, 6 containers. Okay. We imported 6 containers and each container is this purple color box. Okay. We imported 6 containers. Okay. And then what happened was during the year, okay, we sold, let's say, 4 containers. Okay. We sold 4 containers. And then at the end of the year, what is happening? We are left out with 2 containers. Okay. So in the month 0, okay, month 0, we had no containers. Okay. And in the month 0, what we did was, as we had no containers, we imported 6 containers. Okay. Then during month 0 to month 12, okay, we sold 4 containers. Okay. And then at the end of the month 12, we are left with 2 containers. Okay. Now this is what has happened. So basically, in this particular example, okay, at the start of the period, okay, at the start of the period, that is this month 0, okay, that is this month 0, we don't have, now see, we don't have any containers. Okay, at the month 0 we has no containers. That means at the beginning of business, at the beginning of business, we have no opening stock. Okay, we have no opening stock. So what happened is, then we bought 6 containers. Okay, then we bought 6 containers. Okay, we bought stock. Okay, we bought stock, and then we consumed, or we sold 4 items out of that, and then we are left with the closing stock. Okay, now closing stock is how much? How much? Closing stock is how much? We had 0 opening stock, and we bought 6 containers, and then we sold 4 containers, and we are left with 2 containers. Okay, so closing stock is 2 containers. Okay, now here the closing stock is closing stock is 2. Yes. Now then, okay, now the first year is over. Okay, then we are going to the second year. Okay, so second year, that is basically month 13, or we can also say month 0 of the next year. Okay, and it will go up to month 24, or we can say month 12. Make it another. Now this is the first year from months from now. This is the first year. Okay, first year. Now this is the second year. Now accounting period is usually 12 months. So from month 0 to month 12. Okay, the second year, month 13 to month 24. Okay, now we also call it month 0 to month 12. Okay, now in this month 13, or in this month 0, what is this? Can you tell me what is the opening stock? Can someone tell me what is the opening stock? Okay, in this month 13, or in this month 0, this closing stock become the opening stock. Okay, simply these 2 containers. Okay, now these 2 containers, this become the opening stock for the second year. Opening stock for the second year. Okay, so we have 2 stocks. So in the month 0, we had 6. We bought 6 containers, and then we use 4 containers, and then we are left with 2 containers, and these 2 containers become the opening stock for the next year. Okay, now closing stock of the last year, become the opening stock of the Okay, opening stock of the next year. Okay, that is what is happening. Closing stock of the last year become the opening stock of the next year. Now, during this next year, you cannot run your entire business with these two containers, no? Okay, can you remember? See this, these six, and then four use left with two. Okay, now you cannot run the entire business with these two containers, no? So what you do is you will. Okay, so we learned. Okay, uh, so at the month now from the last example. Okay, so we learned in the month zero we imported six containers, and during the year we used four. At the end of the year we are left with two containers. Okay, containers are ship containers. අපි container පෙට්ටි කියන්නේ ඒවා, right? So these two containers that are left in the end of the year becomes the opening stock for the next year. Okay, closing stock of the last year. Okay, closing stock of the last year become the opening stock of the next year. Okay, so as per this example, see, we have two container boxes. We imported six, we used four, and we are left out with two. Okay, so we have two containers. Now in the year two we are opening with a stock of two containers, but what happens is we cannot do this job with two containers alone. We have more sales. Therefore what we do is we are buying another five containers. Okay, we buy three containers on cash. Okay, and we buy another two containers on credit. Okay, we buy two containers on credit. Okay, so now we have seven containers. Okay, out of these seven containers, let's say we are using four containers, then we are left with three containers as the closing stock. Okay, so that is what is happening. Okay, so usually usually what happens in a business is you have the opening stock. Okay, you have the opening stock, and then you have the purchases. Okay, then you have the closing stock. Now the stock relevant to the cost of sales is opening stock plus purchases minus closing stock. Okay, opening stock. Now for the cost of sales, it will be opening stock plus purchases minus closing stock. So that will be relevant to the cost of sales, so the traded goods within that particular period of time. That will be the stock. Okay, then other than these purchases, okay, other than these purchases you have other expenses. For example, let's say loading expenses. Okay, loading expenses. Okay, then carriage inwards. Likewise you may have other expenses. So those has to be added to this as well. Then you will arrive at the cost of sales. Okay, that is how it is happening. Cost of sales. So I will re-explain this. Okay, I will re-explain this. I don't know whether I will do it like this. Let me try doing it like this. Okay, let's say we have a business like this. Okay, sorry. Okay, okay, let's say we have a business like this. Okay, so Okay. Now here it is month 0 or the start of the business. Okay. Here it is month 12. Okay. So this will be the first year. Okay. Then we have the month 24. Okay. This is the second year. Okay. So let me explain about the stock. Okay. How the stock and the other components are being related to the cost of sales. Okay. Now I am going to talk about example where I am doing a business of noodles. Okay. I am doing a business of noodles. I import and sell noodles. Okay. I import and sell noodles. Okay. I import them in containers. Okay. I import them in containers. Containers are ship containers. Okay. Ship containers. I am importing them in containers. Okay. So let's say now as we begin the business, okay, okay, I don't have any stock. Okay. Start. Okay. Month 0. Okay. I have no stock. I have no stock. Then what I do is, therefore, what I do is I import 6 containers. Okay. I import 6 containers. Okay. I import 6 containers. Okay. Then during this period, okay, okay, what happens is during that period, I will use 4 containers. Containers during month 0 to month 12. Okay. Then at month 12, my stock available is called the closing stock. Closing stock. So at the beginning I had 0. Okay, at the start of the business I had 0. Then I imported 6 containers. Okay, out of that I used 4. Okay, therefore at the end of the period I am left with what? I am left with 2 containers. Okay, so that is done and dusted. We know it. Now the important thing is, okay, in the next year, okay, this is happening in the first year. Okay, this is happening in the first year. Now in the second year, okay, okay, closing stock of the first year become opening stock of the second year. Sorry, in the second year, closing stock of the first year become the opening of stock of the second year. In the second year, closing stock of the first year become the opening stock of the second year. What is my opening stock in the second year? That will be 2. Opening stock of second year is 2. Now in the second year, I do not have sufficient stocks to do my operation because I am usually selling 4 containers. Okay, because I will use 4 containers during the month 0 to month 12. Okay, because this year also, let's say I am using 4 containers. Therefore, what I do is I import another 4 containers. Okay, this is my purchases for the year 2. Purchases for the year 2. Okay, this is the purchases for year 1. This is the purchases for year 1. Okay, so these 4 containers, I can import them, okay, as cash and as credit. Okay, so both of them will be considered as purchases, both cash purchases and credit purchases. Okay, so what happens? Okay, so I had 2 closing stock, I imported 4, and now I have 6 containers. Okay, then during the year, okay, during the year, let's say I use, during the year I use 3 containers. Okay, then my closing stock, okay, then closing stock of year 2 will be how much? 2 in the beginning, my opening stock. Okay, then I purchased 4, I used 3. Okay, my closing stock will be 3. Okay, my closing stock will be 3. So in this example, I explained what is happening in with the stocks. Usually in a business, in the month 0, you don't have any stock. Okay, see, at the start, you have no stock. Okay, see, in the month 0, you have no stock. Okay, then what you do is, in this year, you will be purchasing stock. First year, you will be purchasing 6 containers. Okay, then during that year, you will be using 4 containers. Okay, so you had 0 at the beginning, so you purchased 6, and then you used 4. So at the end of the period, you will be left with 2 containers. That will be the closing stock. Okay, now closing stock in this month 12, or at the end of the year, at the end of the first year, the closing stock will be the opening stock of the second year. Okay, see, in the second year, closing stock of the first year become the opening stock of the second year. Okay, closing stock of the first year become the opening stock of the second year. Then as the opening stock, you have 2 containers. Then for that year, for the second year operation, you will be importing another 4 containers. Why? Because that 2 containers is not sufficient for your business. So because of that, you will be importing 4 containers. Okay, these 4 containers, you will be importing 2 containers, let's say some containers in cash and some containers in credit. Okay, this import can also be identified as the purchases. Okay, it can be also identified as the purchases for the year 2, and this 6 container importation is the purchases for the year 1. Okay, now during the year, what happened is, you will be using 3 containers. Okay, you will be using 3 containers. So the closing stock of the year 2, closing stock of the year 2 is, now you started with 2 containers. See, these 2 containers, and then you imported 4 containers, these 4 containers, and then these 3 containers you used it, and the closing stock will be how much? 3. Okay, that will be the closing stock of the year 3. Okay, so we have a good idea about stock usage. Okay, opening stock and the purchases for a particular period, that could be cash and credit, and then the closing stock. So all these components are clear now. Okay, now in terms of cost of sales, okay, in terms of cost of sales, okay, in terms of cost of sales, now we need to calculate the cost of sales. Okay, so the cost of sales will be opening stock. Okay, let me write it in another color. Okay, opening stock. Then to that we are adding the purchases, and then we are deducting the closing stock. So this will be the cost of sales. In fact, for that particular year, for the production, the stock you used, opening stock, add purchases minus closing stock. That will be the cost of sales. Okay. Now these purchases can be cash or credit. Okay. That can be cash or credit. Okay. This is the step one. Okay. Then in the step two, what happened is you take this cost of sales. Okay. This cost of sales, and then you will have to add it carriage inwards, other expenses. Okay. Carriage inwards and shipping fees. Likewise, you will have to add them. Okay. Then that will give you the final cost of sales. Okay. That is what is taught in these slides. Okay. Let me explain. That is what is being told in these slides. Okay. With this graphical example, I wanted to explain you. Okay. That is what is being explained in these slides. Okay. So let me read them out for you. Once the entire stock is sold out, the cost of the inventories that was presented for trade is considered as the cost of sales. Okay. Now, cost of the inventories that was presented for trade is considered what? Cost of sales. Okay. And how did we calculate this? Cost of the inventories that was presented for trade is the cost of sales. How did we calculate this? Okay. Opening stock plus purchases minus closing stock. That is how we calculated it. Okay. But a business organization can have some inventories yet to be sold at the end of the accounting period. Okay. Now we had 6 containers. Okay. We had 6 containers. We used 4 and we are left out with 2. Okay. So, but a business organization can have some inventories yet to be sold at the end of the accounting period. In such a situation, cost of the sales is calculated by deducting the value of the closing stock from the cost of the goods that was presented for the sales. And ඒ කියන්නේ අර මේ අපි කතා වුණ කතාව මේ purchases වලින් මේ closing stock එක අඩු කරනවා කියන එක තමයි මේ කියන්නේ. Right? Then they have given example. The same closing stock at the 31st 12 2015 become the opening stock of 1st Jan 2016 in the next accounting period. That was why what I explained here. Okay. In the second year, closing stock of the first year become the opening stock of the second year. That is what is being told here. The same closing stock as at the 31st December 2015 become the opening stock of the 1st Jan 2016. Okay. There is no opening stock exist for the business in the first year of the operation. Business එක පටන් ගනිද්දි month 0 වලදී you don't have any stock. Okay, you have no stock. In a particular accounting period, a business has to purchase goods to sell as opening stock of a good is not adequate for the sale to be done during the year. So here I told in the second year, I have this two opening stock and I am importing 4 containers. Okay, I told that I am importing 4 containers. Why? Because that the remaining the two containers at the in the opening stock is not sufficient for my entire year's business. Therefore, what I do is I am importing 4 containers. In a particular counting period, a business has to purchase goods to sell, as opening stock of the good is not adequate for the sale to be done in the year. Opening stock එක අපිට මදි හින්දා අපි අලුතෙන් බඩු ගේන්න වෙනවා. Okay. The purchases made in terms of cash and credit totals for the purchases made during the accounting period. See, here I told you, these purchases, you can buy it in cash and credit. So both these cash and credit sales will be included in purchases. Okay, will be included in purchases. So purchases made in terms of cash and credit totals for the purchases made during the accounting period. So cash purchases will be 24,000 and credit purchases 58,000. Then total purchases is 82,000. Then transportation expenses, loading and unloading expenses, etc., has to be incurred when purchasing goods are transported to the business premises in order to obtain the total cost of the inventories. Okay, total cost of the inventories, all the expenses related to the purchases, including the costing incurred in bringing stocks to the current position and condition, should be considered. එතකොට මම ඔයගොල්ලන්ට කිව්වා මේ මුලින්ම අපි කතා වුණා මේ නිකන් මේ ඉන්වෙන්ටරි එක මේ ඕපනින් ඉන්වෙන්ටරි එකට පර්චේසස් එකතු කරලා ක්ලෝසින් ඉන්වෙන්ටරි එක අයින් කරනවා. ස්ටොක් එක කියන්නේ ඉන්වෙන්ටරි එක. දැන් මේකෙන් තමයි ස්ටෙප් 1 එකකින් ආපු cost of sales එක ආවේ. හරිද? ඊට අමතරව we have other expenses. Okay, for example, what transportation expenses, loading expenses, unloading expenses. Okay, so for here I included 2 examples like carriage inwards, shipping fees. Okay, so this has to be added, and that will be in order to obtain the total cost of the inventories, all the expenses related to the purchases, including the cost incurred in bringing stocks to the current position and condition, should be considered. So we calculated it. Okay. Therefore, when calculating the cost of the goods sold, following elements taken into consideration: opening stock. Okay, opening stock, the total purchases including the cash and credit purchases, this one, closing stock. Okay, closing stock. Okay, and then what are we doing here? We take stock. Okay, we have taken the opening stock, and to that we have added the purchases. Opening stock, added purchases. Then we have added other expenses, loading expenses and carriage inwards. These has been added. Okay, then out of that we have deducted the closing stock. See, we have deducted the closing stock, and that will ultimately given us the total cost of sales. Cost of sales is 90,000. Okay, so gross profit is sales revenue minus cost of sales. Okay, that we learned at the beginning. Okay, gross profit is sales revenue minus cost of sales. Okay, so gross profit is sales revenue minus cost of sales. Okay, so that's it. So that is how we go up until the gross profit. Okay, so you can take couple of minutes and start writing the note. Okay, these 4 slides, you can start writing them. Profit or loss statement from this point, cost of sales point. Okay, from that point you can start writing the note.